California's real estate dream is crumbling, and no one's talking about it. In cities once selling homes at $900,000, prices are now slashed by $120,000 or more. Inventory is surging 70%, while foreclosures have tripled in towns like Stockton and Bakersfield. Across the Golden State, properties that sold in 8 days now sit abandoned for 75-plus days, drowning in price cuts. Families are fleeing. Flippers are losing their shirts. This isn't a dip. It's a full-blown collapse in slow motion. These 10 California cities are ground zero for a devastating crash that could erase billions in equity, and it's already begun. Number 10. Milpitas. Milpitas, nestled at the southern tip of the San Francisco Bay, once basked in the Silicon Valley housing gold rush. With its prime location near major tech employers like Cisco and Western Digital, median home prices in Milpitas soared to an eye-watering $1.32 million by early 2022. But in 2025, the shine is fading, fast. As tech layoffs sweep across the valley and remote work becomes a permanent fixture, Milpitas is facing a harsh reckoning. In the first half of 2025, median sale prices dropped 7.8%, now sitting at $1.22 million, according to regional MLS data. That's a nearly $100,000 loss in equity in just 12 months. Inventory is exploding. Active listings have doubled since early 2024, surging from 122 to 248 homes on the market, signaling an extreme shift in supply-demand dynamics. Days on market, which used to hover around 9 to 12 days during the 2021 peak, are now averaging 47 days, a staggering 391% increase. Even new construction projects are stalling. Several townhome developments near McCandless Drive have slashed prices by over $80,000 just to move units. Buyers aren't biting. Monthly mortgage payments on the average home here now exceed $7,800, assuming a 7% interest rate and 20% down. That's over $93,000 a year just for housing, not including taxes, insurance, or HOA fees. Meanwhile, the median household income in Milpitas is $140,000, meaning even dual-income households are stretched thin. With affordability collapsing, flippers and speculators are pulling out, and homeowners who bought in late 2021 or early 2022 are now dangerously close to being underwater. The worst part? Price cuts are becoming more frequent and more aggressive. Redfin reports that 34.6% of listings in Milpitas reduced their asking price in Q2 2025. If the trend continues, home values here could drop another 10 to 15%, putting massive pressure on those holding high-leverage mortgages. Milpitas is no longer a safe bet. It's becoming a cautionary tale. Number 9. Orange County. Orange County was once seen as the crown jewel of California's real estate, a place where ocean views, pristine suburbs, and affluence created an almost invincible housing market. But in 2025, even OC's luxury isn't safe. The median home price here peaked at $1.16 million in 2022. Fast forward to mid-2025, and that number has slipped to $1.03 million, a drop of over $130,000 or 11.2%. And the pain is just beginning. Inventory tells the real story. At the start of 2025, Orange County had 2,594 active listings. By mid-year, that figure has surged to 5,121, nearly doubling in just 6 months. That's a 97% increase in supply in one of California's most desirable markets. Meanwhile, buyer demand has collapsed. Pending sales are down 29.4% year-over-year, and days on market have ballooned from 14 days in 2021 to 43 days in Q2 2025. Higher interest rates are crushing the high-end buyers who once drove OC's bidding wars. At a 7% mortgage rate, monthly payments on a $1 million home with 20% down now exceed $6,200, pricing out even upper-middle-class families. The result? Price reductions everywhere. Redfin reports that over 39% of homes listed in OC had at least one price cut this spring. Luxury neighborhoods like Laguna Niguel, San Clemente, and Mission Viejo are seeing steep pullbacks. In Laguna Beach, properties once listed at $3.2 million are now relisted at $2.75 million with no offers in sight. Sellers are panicking. The real estate agents who were once gatekeepers of exclusive homes are now staging open houses every weekend, often to empty rooms. The problem isn't just price, it's psychology. Orange County thrived on the illusion of wealth perpetually growing. But with stock market turbulence, fewer IPOs, and reduced foreign investment, that illusion is breaking. OC is learning the hard way that even luxury markets can't defy gravity forever. The correction has begun, and it's heading for the high-end homes first. Number 8. Antioch. Antioch was once the pandemic-era darling of Bay Area buyers looking for affordability. Located nearly 45 miles from San Francisco, it offered 4-bedroom homes at half the price of the city. In 2021, the median home price soared to $685,000, driven by remote workers and low interest rates. But in 2025, that story is unraveling. Median prices have slipped to $609,000, a $76,000 drop, and it's not stopping there. Antioch's Achilles heel is its location. With bridge tolls now exceeding $8 each way, gas averaging $5.90 per gallon, and long commutes, the suburb is losing its appeal fast. The result? Inventory has surged 62% year-over-year, with over 440 active listings, compared to just 271 a year ago. Sellers are flooding the market, while buyers are stepping away. Days on market in Antioch have ballooned to 49 days, and price cuts are everywhere. In June 2025 alone, 41% of listings saw price reductions, with some homes slashing more than $50,000 in just 3 weeks. Foreclosures are creeping back in. Antioch recorded one foreclosure per 1,150 housing units in Q2 2025, more than double its 2023 rate. The real estate boom created over-leveraged homeowners who bought near the top with minimal equity. Now, as values drop, they're underwater fast. Investors are also pulling out. Many of the homes bought by institutional buyers in 2021 are now sitting vacant or back on the market at a loss. Antioch's economy hasn't evolved enough to sustain higher home values. Job growth is flat, and wages haven't kept up with housing inflation. The city was built on the idea that people would commute into San Francisco forever. But with hybrid work fading and job cuts mounting, that vision is collapsing. Antioch isn't just adjusting, it's reverting. As reality sets in, this Bay Area satellite is fast becoming one of the state's biggest housing liabilities. For those who bought in 2021, the pain could last years. Number 7. North Tustin. North Tustin, a wealthy, unincorporated enclave in Orange County, has always been associated with exclusivity. With sprawling custom homes, large lots, and tree-lined streets, the median home price here hit a jaw-dropping $1.6 million in late 2022. But in 2025, the cracks in this affluent bubble are widening fast. Median home prices have fallen to $1.42 million, a $180,000 drop, or about 11.25%, and deeper cuts are likely. The root issue is liquidity, or lack thereof. North Tustin's homes are luxury properties, and in a market where jumbo loans exceed $1 million with 7.25% interest rates, monthly payments now top $9,400. Even wealthy buyers are hesitating. Many would rather sit on cash or invest elsewhere than take on massive debt for a depreciating asset. Inventory has surged 78% in North Tustin since 2024, from 84 listings to 150 in mid-2025. Homes that used to sell in under 20 days now sit for 52 days or more. Sellers are nervous and aggressive price cuts are happening. Homes initially listed at $2.1 million are now asking $1.78 million, often still without offers. The market is seeing what analysts call a luxury freeze. The ultra-wealthy are staying put, while mid-tier affluent buyers have vanished. Even realtors admit open houses have turned into ghost towns. There's also a psychological shift. Buyers are worried about catching a falling knife in a neighborhood that once felt immune to downturns. Unlike more diversified markets, North Tustin's real estate depends heavily on equity-based transactions and cash-rich buyers. But with stock portfolios down, IPOs drying up, and inflation cutting into disposable income, demand is withering. And with few entry-level homes in the area, there's no cushion at the bottom of the market. North Tustin may be beautiful, but even beauty can't stop gravity. The correction is underway, and with this level of affluence, the ride down may be even steeper than expected. Number 6. Fresno. Fresno used to be one of California's most affordable cities. But in the pandemic frenzy, affordability turned into overvaluation. Median home prices in Fresno shot up from $285,000 in 2019 to over $420,000 in 2022, a staggering 47% increase in just 3 years. In 2025, the cracks are now spreading fast. The median price has slipped back to $374,000, a loss of over $46,000, or nearly 11%, and experts say more pain is coming. The problem? Local wages never caught up. Fresno's median household income is about $62,000, while the cost of owning a median-priced home has skyrocketed. With mortgage rates hovering around 7%, monthly payments are well over $2,700, which is 52% of the average household's monthly income, far beyond what financial experts recommend. Inventory is swelling. Fresno had 1,370 active listings in mid-2024. Now it's pushing 2,400, up 75% year-over-year. That's creating a buyer's market in a city where buyers are increasingly scarce. Redfin reports that 44% of active listings in Fresno had price reductions in Q2 2025. Flippers are bailing. Investors who bought starter homes at $400,000 in 2021 are now trying to exit at $370,000 and still not finding offers. Days on market have tripled from 12 days in 2021 to 38 days now. Some sellers are even offering cashback credits or paying closing costs to entice buyers. The foreclosure trend is picking up too. There were 290 foreclosure filings in Fresno County in the second quarter of 2025, up 62% from the same time last year. Many of these defaults are tied to FHA and VA loans taken out at the peak with minimal down payments. Fresno's affordability boom has officially turned into a correction cycle. The reality is this: when home values rise faster than incomes and jobs, they eventually crash back down. Fresno is now paying the price for trying to live beyond its economic fundamentals. Number 5. Vallejo. Vallejo, located just 30 miles northeast of San Francisco, was once hailed as the last affordable Bay Area market. Between 2020 and 2022, its home prices surged from $435,000 to $595,000, an increase of 36.7%, as buyers fled expensive cities like Oakland and San Jose. But that boom was never sustainable, and in 2025, the collapse is unfolding. The median home price has now dipped to $529,000, a loss of $66,000 or more than 11%, with inventory piling up fast. As of mid-2025, Vallejo's active listings sit at 782 homes compared to just 438 1 year ago, an increase of nearly 80%. Meanwhile, buyer demand is cratering. Pending sales are down 32%, and over 48% of all listings have seen at least one price cut. In some neighborhoods near Glen Cove and East Vallejo, homes originally listed at $599,000 are now being relisted at $515,000 and still sitting for over 50 days. Vallejo's economy is struggling to support pandemic-era prices. With a median household income of just $75,000, many new buyers stretch their budgets thin. Rising mortgage rates are making things worse. Monthly payments on a $550,000 home now exceed $4,000, more than 64% of take-home pay for most local families. Foreclosures are creeping back in. Q2 2025 saw 197 foreclosure filings in Solano County, with Vallejo accounting for nearly 60% of them. Many involve FHA loans or adjustable rate mortgages resetting at much higher rates. For owners who bought in 2021 or 2022, equity is evaporating. Tech layoffs in nearby Bay Area cities are also hitting Vallejo hard. Many residents commute to jobs in San Francisco, Oakland, or Silicon Valley. But with remote work ending and layoffs mounting, commuting costs and job losses are shaking local confidence. Even rental demand is softening, with average rents dropping by 8.2% since 2023. Vallejo isn't just correcting, it's unspooling fast. What began as a budget-friendly Bay Area option is quickly becoming one of the region's most vulnerable housing markets. Number 4. Modesto. Modesto's rise during the pandemic was meteoric and artificial. As Bay Area residents sought space and affordability, they flooded Central Valley cities like Modesto, driving prices from $310,000 in 2019 to $475,000 by late 2022, a shocking 53% surge. But in 2025, that bubble is now bursting. The median home price has fallen to $412,000, a decline of 13.3% or $63,000 from peak values. What's causing the slide? First, inventory. Modesto's active listings jumped from 584 in mid-2024 to 1,130 today, nearly doubling in just 1 year. Meanwhile, buyer demand has plummeted. Pending sales are down 36%, and over 50% of homes on the market have cut prices at least once. Affordability is crashing. The average household income in Modesto is $68,000, yet owning a median-priced home now requires payments of $3,100 per month, including taxes and insurance. That's 55% of monthly income, and many families are choosing to rent or leave altogether. Flippers are drowning. Homes purchased at $470,000 are now relisted at $410,000 with no offers in sight. Days on market have expanded from 9 days in 2021 to 41 days in mid-2025. Even builders are feeling the pain, with new developments offering $25,000 in incentives just to attract interest. Modesto's job market hasn't grown fast enough to justify pandemic-era home prices. It's still dependent on agriculture, transportation, and logistics, industries with low wage ceilings and high volatility. As gas prices remain high and inflation squeezes budgets, many homeowners are realizing they overpaid for the commuter suburb dream. Foreclosures are rising. Stanislaus County recorded 188 new filings in Q2 2025, with Modesto making up nearly 70%. That includes a growing number of short sales and underwater homeowners trying to exit before values fall further. Modesto's pandemic boom was never built on strong fundamentals. Now, the correction is revealing just how fragile the gains really were. Number 3. Riverside. Riverside, once seen as the affordable escape from Southern California's coastal chaos, is now ringing housing market alarm bells. During the pandemic boom, home prices in Riverside jumped from $390,000 in 2019 to a blistering $585,000 by 2020, mid-2022, a nearly 50% increase. But in 2025, the market is retreating hard. Median prices have dropped to $524,000, shaving off $61,000, or more than 10.4% in just 18 months. Foreclosures are spiking. According to Adam, Riverside saw one foreclosure filing per 721 homes in May 2025, placing it among the highest in the state. Many of these are linked to FHA and VA loans taken out with minimal down payments during peak pricing. Inventory is also exploding. Active listings in Riverside County have risen from 4,930 in mid-2024 to 8,400 in 2025, a 70% increase. And homes are lingering. Average days on market has jumped from 13 in 2021 to 45 in 2025. Redfin reports 42% of listings in Riverside saw at least one price cut this spring. The issue? Riverside attracted buyers priced out of Orange and Los Angeles counties, many of whom stretched budgets to the brink. Now, with mortgage rates at 7.25%, those $550,000 homes come with monthly payments exceeding $4,200, not including taxes or insurance. The financial strain is turning into missed payments and forced sales. Jobs are drying up. Logistics, a key employer in the region, is slowing. Major warehouses are downsizing, and the ripple effects are hitting household budgets. Meanwhile, builders are offering heavy incentives: $30,000 in closing credits, rate buydowns, and even free backyard landscaping, just to move inventory. Riverside's housing boom depended on affordability and migration, but now migration is reversing, affordability is gone, and economic momentum is slowing. The very forces that built Riverside's housing boom are now working in reverse. Fast. Number 2. Bakersfield. Bakersfield is becoming the epicenter of California's foreclosure crisis. This Central Valley city, reliant on oil and agriculture, saw a massive pandemic boom. Home prices jumped from $270,000 in 2019 to $398,000 in 2020-2022, a shocking 47% gain. But 2025 is telling a new story. Prices are now falling fast, with the median home price down to $336,000, a $62,000 drop, or nearly 16%. What's more alarming? Foreclosure filings. In May 2025, Adam reported one foreclosure for every 1,990 housing units, putting Bakersfield among the top 5 metro areas for foreclosure activity nationwide. Many owners bought with low down payments and are now underwater as prices slide. Inventory is out of control. Listings have jumped 83% year over year, from 1,250 in the mid-2024 to over 2,300 today. Buyer demand, on the other hand, is disappearing. Days on market have surged from 10 days in 2021 to 44 days in 2025. Redfin reports that 46% of listings have experienced at least one price cut this quarter. Bakersfield's economy doesn't support $400,000 homes. The median household income is around $67,000, but the cost to own a median-priced home, factoring mortgage, taxes, and insurance, exceeds $3,200 a month, or over 57% of take-home pay. The job market is fragile. Oil prices have been volatile, and agriculture is under pressure from drought and water regulations. That's creating uncertainty for homeowners, many of whom are relying on gig work or inconsistent employment. Flippers are abandoning projects midway. Builders are halting developments, and cash investors are sitting on the sidelines. Some neighborhoods, especially in southeast Bakersfield, have homes that were listed at $380,000, now struggling to attract offers, even at $310,000. Bakersfield's rapid rise during the pandemic was never sustainable. Now the market is in free fall, and without economic diversity or income growth to stabilize it, the correction is likely to get even uglier. Number 1. Stockton. Stockton has become the poster child for California's slow-motion housing collapse. Once praised for its affordability and strategic location between Sacramento and the Bay Area, Stockton saw its home prices surge from $325,000 in 2019 to $460,000 in 2022, a 41.5% increase. But in 2025, the downturn is not just visible, it's accelerating. Median home prices are now down to $420,000, a $40,000 drop, or 8.7%, with steeper declines likely. Inventory is flooding the market. Active listings have exploded 70% year over year, climbing from 900 in mid-2024 to over 1,530 in 2025. And it's not just more homes, it's longer waits. Days on market have hit 75 days, the highest since 2011. Homes that once sold in under 2 weeks now sit for months with multiple price cuts. The foreclosure picture is bleak. Filings in San Joaquin County have tripled since 2022. Stockton alone accounts for over 61% of all county-wide defaults, and many of these are primary residences purchased in 2021-2022 with FHA loans, minimal equity, and inflated expectations. Real estate investors are pulling out. Pandemic flippers who paid $450,000 are now relisting at $380,000 and still getting no offers. Redfin shows that 52% of Stockton listings in Q2 2025 were discounted, with the average price cut around $36,000. The local economy hasn't helped. With a median household income under $69,000, the monthly payment on a $420,000 home at 7% interest exceeds $3,300, more than 57% of gross monthly income. And with layoffs in logistics, education, and healthcare mounting, Stockton families are on edge. The most dangerous trend? Short sale inquiries are surging. Underwater homeowners are looking to offload before prices drop further, and many are walking away from mortgages they can't sustain. Stockton isn't just falling, it's leading the collapse. It's the first major California city where all the signs, inventory, price cuts, foreclosures, are flashing red. And for those still holding on, time is running out.